Listen up, investors. Whether you're a seasoned trader or just starting out, understanding the stock market is crucial. You wouldn't watch a game without a scoreboard, right? Imagine trying to follow your favorite team without knowing the score. It would be chaos. That's what a stock market index is, a way to keep score. It helps you track the performance of a group of stocks, giving you a clear picture of how the market is doing. It tells you how a group of stocks is performing. Just like a scoreboard shows the score of a game, an index shows the performance of the market. Think of it like a snapshot of the overall market's health. It provides a quick and easy way to see if the market is doing well or if it's struggling. Is it up? Is it down? These fluctuations can tell you a lot about the current state of the economy and investor sentiment. Indexes give you the big picture. Indexes are everywhere. They are essential tools for investors, providing valuable insights into market trends. You've got the Dow Jones Industrial Average. This index tracks 30 large, publicly owned companies based in the United States. You've got the S&P 500. This index includes 500 of the largest companies listed on stock exchanges in the US, offering a broader view of the market. They track different parts of the market. Each index has its own unique focus, providing insights into various sectors and industries. And believe me, they're important. Investors rely on these indexes to make informed decisions about where to put their money. They can tell you if the bulls are running or the bears are in control. Bull markets indicate rising prices, while bear markets signal falling prices. So, if you're serious about investing, you gotta understand indexes. They are the key to navigating the complex world of the stock market. By keeping an eye on these indexes, you can gauge the overall market sentiment and make more informed investment choices. Historical data from these indexes can also help you understand long-term trends and patterns, giving you a better perspective on future market movements. So, next time you check your portfolio, remember to look at the indexes. They are your scoreboard in the game of investing, helping you stay on top of your financial game. Educate yourself about the different indexes and what they represent. The more you know, the better equipped you'll be to make smart investment decisions. Whether you're investing for retirement, saving for a big purchase, or just looking to grow your wealth, understanding stock market indexes is a crucial part of your financial journey. So, keep learning, stay informed, and use the indexes to your advantage. Happy investing! Okay, so what exactly is an index? It's a basket of stocks. It represents a particular market or sector. Like, the Nifty 50 in India tracks the top 50 companies on the National Stock Exchange of India. Easy, right? The index's value is calculated based on the prices of those stocks. If the prices go up, the index goes up. Simple as that. It's a way to measure how well those companies are doing as a group. Let's talk about the Nifty 50. This index is a collection of the top 50 companies listed on the National Stock Exchange of India. It's a benchmark that reflects the overall performance of the Indian stock market. It's like the dream team of Indian companies. These are the giants that drive the economy forward, representing various industries and sectors. From banking to IT, it covers a wide range of sectors. You'll find companies from pharmaceuticals, energy, consumer goods, and more. This diversity ensures that the index is a comprehensive snapshot of the market. This makes it a great barometer for the overall Indian economy. When these companies perform well, it often indicates a healthy economic environment. Investors and analysts closely watch the Nifty 50 to gauge market trends and economic health. When the Nifty 50 is up, it means investors are feeling good about India's future. It reflects optimism and confidence in the market, often driven by positive economic news, strong corporate earnings, or favorable government policies. And when it's down, well, it might be time to look a little closer at what's going on. A decline in the Nifty 50 can signal economic challenges, such as slowing growth, political instability, or global market pressures. But remember, even in a downturn, the Nifty 50 can highlight opportunities. Savvy investors look for undervalued stocks or sectors poised for recovery. It's a dynamic index that offers insights into both risks and rewards in the market. Now, let's talk about a real heavyweight in the Nifty 50 Reliance Industries. This conglomerate is a giant in the oil and gas sector. They've got their hands in everything from refining to retail. And they've got a huge impact on the Nifty. When Reliance does well, the Nifty often follows. It's that simple. Why? Because they represent a big chunk of the index. So, if you're looking at the Nifty, you gotta keep an eye on Reliance. Section 5. Charting the course. Moving averages and RSI. In this section, we will delve into two fundamental tools of technical analysis that traders and investors use to make informed decisions in the financial markets. Technical analysis. It's like reading the tea leaves of the market. By examining historical price data, traders attempt to predict future price movements. You're looking for patterns and trends. These patterns can provide insights into the market's behavior and help you make better trading decisions. One way to do this is with moving averages. Moving averages are a popular tool because they help smooth out the noise in price data. It smooths out price data and shows you the overall direction of a stock or index. By averaging the prices over a specific period, moving averages create a clearer picture of the trend. Another tool is the Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. It tells you if a stock is overbought or oversold. When the RSI is above 70, it indicates that a stock may be overbought, and when it is below 30, it suggests that a stock may be oversold. Think of it like a thermometer for momentum. It helps you gauge the strength of a stock's price movement. High RSI? Might be time to take some profits. When the RSI is high, it could mean that the stock has been overbought and might be due for a correction. Low RSI could be a buying opportunity. Conversely, a low RSI might indicate that the stock is oversold and could be poised for a rebound. By using these tools, traders can better navigate the complexities of the market and make more informed decisions. Section 6. Infosys. Beyond the charts, a look at fundamentals. Technicals are important, but don't forget about the fundamentals. These are the building blocks of a company. Things like revenue, earnings, and debt. You gotta look under the hood. Let's take Infosys, another Nifty 50 giant. They're a tech powerhouse. To really understand Infosys, you need to look at their financials. How's their revenue growth? What's their profit margin? Fundamentals give you the full picture. Section 7. HDFC Bank, a brick-and-mortar giant in a digital age. HDFC Bank is another big player in the Nifty 50. They're a banking giant. But even in the age of fintech, you can't ignore traditional financial institutions. They're still the backbone of the economy. HDFC Bank's performance can tell you a lot about the health of India's financial system. Are loans growing? Are deposits increasing? These are the kinds of fundamental questions you need to ask. Section 8. Shaking things up. When indexes change. Indexes aren't static, they change over time. Companies get added, companies get dropped. This is called rebalancing. And it can have a big impact on the index's performance. Why does it matter? Well, when a company gets added to an index, mutual funds and ETFs that track that index have to buy that stock. This can drive up the price. The opposite happens when a company is removed. Section 9. The big picture. Why indexes matter. Indexes give you a benchmark to compare against. They help you measure your portfolio's performance accurately. If your portfolio is consistently lagging behind the index, it might be time to reassess your strategy. But remember, indexes shouldn't be your only guide. They're a valuable tool. Use them to understand the market trends, but don't be afraid to do your own research and analysis. Section 10. Investing. It's more than just numbers. Investing isn't a game of chance. It's about understanding the companies you're buying into. It's about having a long-term vision. And it's about managing your risk. So, pay attention to the indexes. Learn the language of the market. But never forget that behind every ticker symbol, there's a real company with real people and a real story. That's where the real money is made.